Hey everyone, so lately I've been seeing a lot of interest in the Singapore markets as it hits an all-time high. It's quite funny how 3 to 4 years ago I did not see a single person interested or talking about the Singapore market. But all of a sudden when it hits all-time high, all I hear is, should I invest in the Singapore market? Should I invest in banks or REITs? The FOMO is quite real, honestly. I've been investing for a few years now, and I know dividends are a big thing in the Singapore investing community. But in this stage of life, I'm not focusing on dividends just yet. And in today's video, I'm going to share with you exactly why, show you the data comparing growth versus dividends, and most importantly, I'll address why the safety people crave or know in dividend stocks is actually more of an illusion than you think it is. So without further ado, let's dive into today's video. I am 29 years old and investing about $1,200 a month. All the money that I put into the market is meant for my retirement 10, 15, 20 years down the road. I think Singapore stocks are amazing form of investments if you are looking for a dividend or income approach to your portfolio. I'm just sharing why I am personally not investing heavily in them right now. From an index perspective, the Singaporean stocks or STI hasn't returned as well as the US market historically. Past performance of course doesn't dictate future results, but that's the conviction I currently have with the US stock market. That said, I'm also not saying the US is the best or that it will always outperform. The US can also experience what we call a lost decade, especially with valuations so high right now. Markets tend to come and go, and that's why diversification is always key. If your goal in investing in Singapore is for diversification purposes, spreading your risk across different countries or markets can actually be a solid strategy, because I have such a long runway of 15 to 20 years before I even think about retirement. I'm positioning myself to capture the full power of compounding and growth. My plan is to stay aggressive through my 30s and probably only start shifting towards safer, more income focused investments around my mid 40s. Right now, I don't need any of my portfolio to pay for my bills. That means that I can focus purely on growth and total returns and let my capital compound as much as possible. Instead of taking little payouts in the form of dividends that I will receive, which I would just reinvest anyways. If you're chasing a 5% dividend yield right now in your 20s or 30s, you're essentially choosing income today over wealth tomorrow. And for me, at this stage of life, that trade-off isn't the most worth it. An extra 1% compounded over 15 years is actually going to make a huge difference in your portfolio. If you take just $100,000 compounded at 6% versus 5% growth over 15 years, the difference is about $32,000. Now imagine a 2 or 3% difference over a larger initial amount. The numbers will be far different from what I present to you. A lot of people believe dividends are a safe form of investments, and I get it. It feels good to receive that quarterly payout, but safety isn't always what it seems. So in 2008, during the global financial crisis, Singapore rates didn't just dip, they crashed about 75% from peak to trough. The STI dropped about 62%. On top of that, during 2020, during the COVID pandemic, dividends was also cut by the local banks, meaning that your stable income can get just as easily affected as your growth stocks. When things get tough, both the stock price and the dividends can actually take a hit. That's why at my stage of life, I rather own a growth business that might take a 40% hit but has the potential to come back stronger rather than chase income that might disappear when I need it the most. Your STI literally only recovered back to its all-time high from 2008, meaning that it took 18 years for this recovery to happen. So now I'm actually going to talk about conviction over hype. This actually brings back to something that changed everything for me. During my first 1 to 2 years of investing, I used to be a hype chaser. I see a YouTube video about some top 10x stocks and then browse Reddit on Wall Street bets, and I'll immediately start to buy those companies hoping that I will get some form of quick returns without even doing the work to understand what I was buying. And I believe in making money quick. And this is the same thing I feel like when I see people all around me starting to invest both in the US and Singapore markets right now. But I learned it the hard way. When the correction comes, and it will with any market you invest in, the people who will sell out or panic are often the ones who got into the markets because of FOMO or hype. They believe that the markets will never drop or they think that things will always work out. So what is actually my plan now? My plan is to stay 100% invested in growth focused for at least the next 5 to 10 years. But along the way, of course, I will evaluate my positions and portfolios and shift it to Singapore assets if I deem the valuation to be very attractive. So when I'm 40 or 45 years old, that's where the transition will probably happen. Change all my compounded pile of capital and move it into a stable dividend paying stocks or ETF like the Singapore banks or the STI. But that's at least another extra 15 or 20 years down the road. More money and more compounding now will equate to a bigger dividend in the future. At the end of the day, it really comes down to knowing what stage of life you are on in this investment journey. If you're in your 40s or 50s approaching retirement and you want to de-risk your portfolio or have something to pay off your daily essentials, dividends make total sense. But if you're in your 20s or 30s still earning that first pot of gold and still having about 30 to 40 plus years before retirement, maybe you can consider holding off dividend investing for a little bit, because that amount of money that you make from dividends won't actually make a significant amount of difference at this stage of life. Yes, by all means, if you think that starting a small position in the Singapore banks might be beneficial for you to focus a little bit on dividends or learn how dividends work, by all means, I think that's an absolutely great way to start. Focus on compounding first if you can. Learn to manage your emotions when the market goes up or down. Build that conviction so that by the time you hit a later stage in your life, you're already ready to pick up dividend stocks. You already have a solid foundation, and transitioning to a lower volatility income focused portfolio becomes easier. At the end of the day, my job isn't to tell you what to do. My job is just to share with you my experience and perspective, and so that you can make your own informed decision for yourself. Thanks for watching. I hope that this gives you some form of clarity on your own strategy. Like, subscribe, and follow along on this journey. Have an amazing week, and I'll see you in the next one. Bye bye.